single model that I trade with, every PD array that's a plot works like gangbusters. But you can appreciate that as a new student or first-time listener. It doesn't make any sense to you what that means. What does that mean, high resistance? What does that mean, low resistance? What do you mean a macro? 10 minutes before the top hour, 10 minutes after hour. What am I supposed to do with that information? You have to see it repeatedly used, referred to. And students that have been around for a long time now just know this is an easy recipe for building a model. Everything, whether you use a breaker, whether you use an inversion fair value gap, a standard fair value gap, a propulsion candle, entry drill, Gallo, all those things, if they appear in that structure, you have a model that is defined by ICT concepts. Moving parts of it, not many. But that's what's lacking. It's not because my concepts don't work. It's because you don't know how to use them. What's the bias? It's going to be derived because smart money is working in that weekly high time frame because they're moving billions of dollars. They're not trying to do 10 penny trades here, 10 penny trades there. They're not small nickel dime. They're not worried about getting execution on that 1 minute fair value gap. But that 1 minute fair value gap yields an opportunity for leverage. We don't have to force $20 billion in the course of this trading week coming up. But they might. And they have to spread that out over orders, over costs, several days. So we have a whole lot of advantage as a small trader, somebody that's working with lower leverage, but we can make a lot of money trading with that lower leverage. The opportunities that Goldman Sachs or investment banks like them, they don't have as many trading opportunities as we do. So they have to be very selective. Their quality and quantitative analysis has to be more stringent. It has to be very meticulous. They just can't go in there and willy-nilly every little. That's why they talk down about any intraday trading, because their models don't afford them the luxury of being able to do that. But because they say that, people that are brand new or they listen to these people wearing blue suede shoes and then block me when I comment on them. I think that was years ago, by the way. Thank you very much. The kind of men only do that. Nobody can time the market. Then they can do that consistent. Man, they just don't know. If it's true, that means they have to Sachs said so. I'm an alumni from Goldman Sachs. And to say anything outside the scope of what they teach in their theology about why markets go up and down, it would be contradictory to what they teach. So they're never going to admit to do that because it flies in the face of the logic that they promote. And if they change that, what do they lose? They lose their identity as it doesn't mean anything. Because there are traders that I've produced that have out-trade them. I have seen other people management. That's the key here, folks. But they've used retail logic and they run circles around Goldman Sachs. It does not diminish the quantitative and qualitative analysis within them. I'm not going to diminish that appreciation. It shouldn't be owed to that. It is. I mean, I have a measure of respect for it. But to speak from that perspective and say that they're the trading authority and anything opposed to what they do and what they say is nonsense. That in itself is nonsense. Because you have seen me literally call it to the tip. Trade it with a real account. It's not always a demo account, baby. It's not always. And you've seen my own students do that with their own analysis. So yes, Virginia, there is something a whole lot more than just so if you strip your trading down like that and you approach it with, I want this to be very simplistic for me. I want to know when not to trade and when I should be focusing on taking trades. What happens if you have things like you arrived at a bias in the weekly chart and you think it's going to go higher? You clearly see there's a fair value gap on the weekly chart that you could trade up into, and it affords you at least 150 handles before it gets to the low of the fair value gap above market price. on a weekly chart. So that means you have a really decent range. What happens if the next trading day has a 8:30 medium impact news driver, and it's all it has? There's no other news after that. And you sit in front of the charts, and at 8 o'clock, everything's setting up. You can see clearly they've left overnight London relative equal highs. And if it opens up in a manner where there's a discount gap, now there's no way to determine that for sure. If you're looking at 8 o'clock, it's 90 minutes away when everything that happens. But it's already giving you a framework that it's there. How I treat the pre-market session is I think that right before the news comes out, I treat that as the opening bell. What I'll do is I'll wait for that manipulation at 8:30. Usually it'll drop down, take out some kind of short-term swing low, or trade into a very small inefficiency like a fair value gap, or trade into an inversion fair value gap, something that was expected to send prices lower earlier, but now it's become an inversion fair value gap. So it'll trade down into that, and then that's the Judas sign at 8:30 over. And then I would look for a long, either that drop down as a Judas at 8:30, or if you're not inclined to do that, then what you would do, where you would expect to see proof of low resistance to underlying conditions, expect it to do that, but don't engage it yet. Then wait for it to trade up, create a short-term shift in market structure, bullish on a 1-minute chart minimum, and then see it create a smaller fair value gap that trade down into, and then that would be your entry. You don't need it to be a trade that has a stop loss below the lowest low at the Judas. You don't need that. Because if you understand the fair value gap, you'll know that it's not required. And then either they'll run those low equal highs, or on the Judas swing, or the Judas swing, the opening range. People will chase that, but you're up equal high, those spots southwestern. And then at 10 o'clock, the retracement will come in for people that are chasing. Highly lofty, complicated speech. No, it's a very simple thing. Very, very simple. In a very binary way, when it's likely to be absolutely it can, but it's more likely that it won't. So you shouldn't be surprised that if you go into that day expecting it to occur, but then every fair value gap stays filled in, or if there is a fair value gap, it goes into it and spends time inside of it, or all the previous candles, every time a candle closes, the new candle overlaps the majority of that previous candle. You're in high resistance to program conditions. Turn the charts off and go do something else. And I mean that. That will make you more profitable than anything else I have. And I mean that wholeheartedly, God's honest truth, because that will filter out all of the unforeseen days where you go on tilt. promise you, if you go back and look at all the times that you blew your account or you went in, or you just hurt yourself financially, you did it on a high resistance to run day. Beyond a shadow of doubt, I guarantee you that's where it happened. And with everything like a nutcase. Like I was literally in there journaling everything. That's when paper and ink was cheap. I have a lot of that stuff. I have 3 volumes full of things like that. And when I would go through and look at all my bad times, the thing that jumped out at me was every day that I lost money, the chart would, that was the language I had to create to articulate the things that I had in my mind. But watching price on days that are very overlapping, it's the easiest way of saying it, where every individual candle shares the run conditions look like. Now, it doesn't mean that it won't create fair value gaps on those days, because it can, most likely will. But what happens is it generates a form for a little while.